As feared, Bitcoin has followed the worst-case scenario. Those of you who watched my video 3 days ago titled Bitcoin's worst-case scenario at this point should have had more than enough time to prepare and respond accordingly. So what can we expect moving forward? Let me quickly share the key points with you. This is the 1-hour chart. First, we detected institutional selling traces, followed by whale selling traces as well. Historically, when institutional selling pressure is followed by whale selling pressure in the same direction, the market typically experiences a deep short-term correction. This is the 2-hour chart. Institutional and whale selling traces were detected simultaneously on the same candle. In cases like this, the market also tends to experience a deep short-term correction. This is the 12-hour chart. Similarly, institutional and whale selling traces were detected simultaneously on the same candle. Finally, this is the daily chart. The whale accumulation trace visible on the left occurred on November 6, 2024, the day Trump's election victory was confirmed. This is the first signal since then. Yesterday's date, October 10, 2025. After almost one full year, a whale selling signal has appeared. Looking comprehensively from short time frames to long time frames, even if there's a temporary bounce, the probability that this is the starting point of a major correction appears quite significant. So how should we respond moving forward? Let's examine the market situation using the hidden volume indicator. This is the 1-hour chart. While the regular volume candles show selling pressure, the hidden volume indicator at the bottom shows buy side overwhelming the sell side. This is the 2-hour chart. Similarly, while the regular volume candles show selling pressure, the hidden volume indicator at the bottom shows buy side overwhelming the sell side. Now this is the 12-hour chart. Here too, while the regular volume candles show selling pressure, the difference is the sell side is overwhelming the buy side. Finally, this is the daily chart. You can see that the sell side is similarly overwhelming the buy side. Let me also show you some positive aspects. Among on-chain data, there's an indicator called CPG, which stands for Coinbase Premium Gap. This indicator shows the phenomenon when U.S. institutional investors buy or sell more aggressively than global retail investors, expressed through graphs and numerical values. In normal trading volume, this indicator's graph barely fluctuates. Similarly, with the hidden volume indicator, when specific volume candles with overwhelming trading volume compared to the average show opposite patterns to regular volume candles, I interpret this as someone intervening in the market. In this recent drop as well, after the price fell, not after some time had passed, but with an immediate reaction, buying pressure that retail investors could never generate appeared behind the selling volume candles. That's right, someone clearly dropped the price intentionally and in a very short time, or rather instantaneously, accumulated massive volume. So from now on, the interpretation can be summarized into two scenarios. First, the start of a bear market. Second, institutions starting to accumulate volume through this correction. First, let me show you the primary and secondary support zones I'm personally watching. On the 12-hour chart, the zone where whale accumulation signals occurred, and since this area has multiple very thick order book levels, if this is truly the start of a bear market, I believe it will completely break below 101K. Usually, order book levels like these rarely break through in one go. While automated trading will run on its own, for my personal trading, if the price falls below this zone, from that point on, I'll consider it the start of a downtrend and plan to continue trading primarily with short positions down to around 93K. So why did I set the target at 93K? It's the only recent unfilled CME gap zone. While CME gaps don't always get filled in the market, they always act as strong psychological support and resistance zones. Market research already shows that the probability of Bitcoin CME gaps actually being filled based on current statistics is approximately 77 to 85%. That's a quite high probability. However, if you analyze at what point and in what situation the price will move to fill this gap, according to market conditions, it can be extremely useful information. Just a few days ago, Bitcoin hit new all-time highs, and everyone was shouting, "To the moon," expecting only upward movement. But the CME gap that formed on September 29th was filled precisely in just one day by yesterday's drop. Let me provide a final summary. First, assuming the current correction ends and the price rises again, using the hidden volume indicator and the indicator that detects whale and institutional trading traces that we've provided to you, the strategy of gradually accumulating volume within the zones I mentioned today, or a strategy of starting to accumulate from around 101K. In that case, set your stop-loss line precisely, and if the price breaks below 101K and the trend shifts to a downtrend, instead of averaging down, boldly reverse your trading direction. If you proceed this way, since you can accumulate volume in zones with very favorable risk-reward ratios, I believe there will be sufficient rewards for your patience. Lastly, assuming this is the start of a bear market from now on, based on the 2-hour chart, in the zone where institutional and whale selling converged from 113.8K to 116.6K, entering short positions with low leverage is also a decent strategy relative to risk-reward. The target would be around 107K, the low of yesterday's drop candle, for partial profit taking, and holding the remainder to the 101K zone also looks reasonable. However, you mustn't always trade with a stop-loss set, and if the trend breaks, averaging down will only increase your account losses, so I recommend taking your hands off the mouse. And even if the trend shifts to a downtrend, there's no such thing as mindless decline. You need to identify new entry points each time to enter short positions. By entry points, I mean zones with favorable risk-reward ratios. If you enter positions without criteria, even if it's a trend-following position, you can frequently get liquidated by short-term whipsaws. If you've set your criteria, waiting is also part of trading. The whale and institutional trading detection indicator and hidden volume indicator you've seen so far can be applied directly to your charts through the link in the pinned comment. These are proprietary indicators we've developed ourselves that are on a different level from other indicators you've encountered. Just try using them for a few days, and you'll definitely feel the difference. With future updates and various new indicators coming soon, please subscribe and turn on notifications so you can immediately access great trading tools and information as they're released. I'll see you again in the next content. Thank you.